Hey gang, welcome to Dr. Frank's Finance World. I am Dr. Frank the Bank, where I try to find you ways to make new money in the world of finance. So this is Finding Assets Part 2. I think it's a pretty interesting one because I found some rare, I would say, articles in the past, and I'm going to hand those to you here on a silver platter. But basically, part of finding assets is sometimes digging pretty deep and finding some small companies and some small opportunities. So the size of the firm actually matters, as I've discussed before. Large firms tend to earn one return. Medium sized tend to earn a little more. Small earn a little more. They actually go down to something called micro cap. And the smallest of the small is one actually called NanoCap. One of the authors of the books I suggest out there, Paul Sonkin, has a number of years of experience in this area and a couple of different articles I want to make you aware of. He was in charge of something called the Hummingbird Investment Strategy, and it kind of looked like this. So ultimately, they were a nano cap, which was very small and also value oriented, which is finding firms that are kind of out of favor or selling for cheap, essentially. So he doesn't do this anymore, but it was pretty interesting back then because they walk you through the process of never seeing a hedge fund or a money market manager, maybe other than Peter Lynch, who walked you through the specifics of exactly what they did, and you can go look this up out there. But anywhere they would look for traditional Graham and Dodd value investing. One of his other interviews talks about him having a class at Columbia in his master's program with a guy named Greenblatt, who was a value investor. He was only there for a couple of years, but the Greenblatt guy was, but it did impact him on what he felt about value investing. Of course, the basic premise of value investing is you figured out something about a company that's cheap that Wall Street hasn't figured out, and you hope eventually they do, and that drives up the price. But he dealt with microcap and nanocap, how they put their portfolios together, and so forth. So it gives the nod to Graham Dodd, value investing. You can read what he has to say about their pretty good author, actually, good writing technique anyway. Our basic aim is to buy securities, a fractional ownership of a company at a discount to their intrinsic value. And they look for five factors: potential upside, of course, evaluation, how sure they are of the outcome that the firm will eventually be fairly valued, how long it will take to close the gap, because there is, in you investing in it, you're presuming you know that Wall Street, more than Wall Street does, I guess, that the firm has not achieved its potential yet, and they have to have some feel for when that might happen. And then the margin of safety, how cheap are you buying the firm and how much money are they making and things like that. So there's a significant opportunities they talk about in there. They were buying companies that have a market cap of sub 50 million. So let's put this in perspective. The smallest of the S&P 500 tend to be 3 to 5 billion. So they're about a 100th the size of the smallest one, and that is the largest that they have out there. And compared to Apple and so forth, you're looking at probably 100,000th the size of companies like that. But look at trading volume and that type of stuff to make sure, like I've said, always have to make sure there's volume. But they talk about how they put the portfolio together, which I think is fascinating. Nobody's ever done that I've ever seen before. And they look for moderately neglected companies and deeply neglected companies and hybrid securities, opportunities to make up the difference, arbitrage, get somebody else to buy them, and that type of stuff out there. So then they do look for liquidity, whether they make cash or not, generate cash out there. They prefer lower correlation to the market, which is what most hedge fund managers are looking for, something that doesn't move directly to the market, and there's something that can provide them with limited risk by having asset values that might turn into something. So anyway, they talk about it out there. For example, we were recently purchasing a company with a $2.7 million market value. I heard today in early 2023 that Microsoft hit 2 trillion, which would be it's 1,000 times 1,000 million is a billion, and 1,000 billion is a trillion. So this is 1 millionth the size of those. But anyway, they talk about the different ones they get to, what criteria they look for, how they actually go out and find them, the overlap between internal and external value, and so forth. and then some search strategies, which to me is just fascinating to walk through and tell you exactly what they did. I've never really seen that before, to be honest with you. So anywho, a lot of information about executing, costs, trading, and all the rest. So another one within the Paul Sonkin world is this Tarsier Nano Fund Letter. And what's interesting about that, to me at least, is it hits a little bit different perspective out there. When you talk about that here, they're talking about, we fish deeper, we fish alone, and so forth. The value fund, they give their performance relative to different indexes, including a microcap index and so forth out there. They talk good and bad about what's gone right or wrong. And anyway, they give some background information on the performance and so forth. Where is it? I was reading in here how big these firms were. I want to make sure I hit on that. We continue to focus on the smallest of the small. The weighted average market cap of the companies in the portfolio was $6 million, with a median market cap of 2.8 million. These are very, very, very small companies. So anywho, they give more information about a railroad and how they found a cheap railroad play they had out there, some of the financial information on them, further view of our search process out there. Anyway, price and shares and so forth for Company O and how they decide whether to own it or not. And Vitreous Glass, simple, boring, but profitable, which is one of the things that Peter Lynch liked as well, that it is in a boring business and so forth. So anyway, it's just pretty amazing that they would give you this much information. Not to finish or spend the whole time on Paul out there, but here's an interesting YouTube video that you can pull up from him as well. You can grab it at that address right there. But if you were to pull that up, it would actually look like this. And here's a company that does look at all these type things, value and so forth. And, there's Paul talking about how he bought things and all the rest out there, and really kind of a fascinating analysis of what happened when the market sort of hit the skids in 07, 08, 09, and what that meant for the liquidity of these really small firms. So once again, I just thought that was pretty fascinating. You can get it, and read it if you want. How to profit from broken markets and the micro caps and all that kind of stuff. He's also an academic and has taught at Columbia University before. Finally, if you want to look at it, Guru Focus out here has an interview with him, and that's right here. And they put a lot of ads up there, but basically with the microcap value guru Paul Sonkin, and they give, oh good Lord, Warren Buffett that. So, but they give a lot of information about his past and how he looks at value investing, and a bunch of really interesting things. Some articles that he's read that he has found interesting in his investment world and lifetime out there. And this pink sheets is stuff that isn't listed. It's actually where Wolf of Wall Street went to find their stuff. But how do you find these companies that aren't trading very often, and how do you know whether they're worth investing in? He spends a lot of time going over that. So just really interesting, unique articles as far as I'm concerned. One other aspect of funding the assets is, where are we in the business cycle, basically, versus the economic cycle, and then the stock market. So, it's interesting here. They talk about, look at how pretty it looks, little bell-shaped curves or waves or whatever here. And it's interesting to note, though, before we ever hit the trough of a recession, but partway down, typically the stock market tends to bottom out. And that's what research I've done has shown as well. 6 to 9, maybe as much as 12 months out, the market will already turn up before you hit the bottom. So I think when people are looking at the Fed in 2023 here, and whether they're going to start easing up or at least not raising as much, I think they're looking out 6 to 9 months and starting to call a trough, which is why I've been moving my money and more of my clients' money into the safer investments, the utilities and the value stocks and that kind of stuff. But basically, I think we're probably here as far as, if this is the economic cycle, this is the stock cycle, and we may well be heading towards a new bull run. We'll have to see what happens to profit margins and some of that kind of stuff. But basically, the stock market leads out, and they talk about different firms to be involved in. For instance, in this bottom to early bull market, they say invest in transportation companies and financials. That's part of sort of Dow theory, if you will, that we can't come out of a market until banks can loan money and they're actually transporting things. And when you look at it worldwide and ships moving around the world, we're not really even that close to the bottom transportation wise. But, there's the other dynamic of not having around the world supply chains anymore and what that means. So it's a lot of moving parts, but it is interesting to note. And by the way, this almost exactly matches the research of the guy at Texas Tech and his stuff that I've done, Jeff Mercer and so forth. I use that when I invest myself. So anywho, I thought that was interesting, worth looking at. There's a lot of other interesting things that go on the market, like these dark pools and algorithmic trading. Not sure how easy it is to make money off of them, although I will say algorithmic trading, to me is at least, got to be based on some distribution or some distributional assumption, with the most likely one being a normal distribution, a bell-shaped curve, which is why I believe there is some help you can get from Bollinger Bands and relative strength. You can see that in the technical analysis videos I have on that. For as far as extra risk out there, you could short a stock or go on margin. Shorting means you borrow it now and sell it and hope to replace it at a lower price in the future. You pay money on that. The other part of shorting is, through history, the market is up 6 out of 10 days. So shorting is a little bit of a loser's game. It's something to think about if you have specific knowledge. Margin means you borrow money from them and buy more stock with it. The nice thing about these relative to options is you don't have to be right about the timing. I mean, you can hold on to these and pay the interest on it, which is a lot of times about 6 or 8%, sometimes more per year. But the bottom line is, with an option, either a put or a call option, particularly when you're buying them, you have to be right within a specific period of time before the option actually expires. So it's when you're looking at adding risk tactically to a portfolio, think about the time frame that you need to be right and determine whether you're going to use either shorting or margin or options. Most often I tend to use options. And by the way, we will have some interesting, a whole derivative series world on that, including some pretty cool Excel files I have to help you figure out risk and that type of stuff. Special topics I did want to go over for all the investors out there. We all typically do a 401k or something, and many times they will stick you into something that is called a life cycle fund. And it's the idea being is it has more stocks early on, more equities, and more debt later on, but it follows sort of a pattern, a structure from your 20s or 30s all the way approaching 60 and so forth out there. It's very, very common, but I'm not real fond of it because of the research that I'm about to show you now. There's been a lot of research about this dynamic life cycle strategy. In other words, putting you in a fund that, if you've got 40 years from now and it's 2023, you'd be in the 2060 or the 2065 target date fund out there. But life cycle funds offer to retirement plan participants gradually reduce their exposure to stocks as you get older. We show that such deterministic, in other words, just so much per year and all the rest out there, switching rules produce inferior wealth outcomes for investors compared to strategies that dynamically alter the allocation between growth and conservative assets based on cumulative portfolio performance relative to the target age. So basically, having more growth when you're younger and value when you're older, at least conservative investments, is a smarter way to go, because one of the things I don't like about life cycle funds is, yes, it's fees on top of fees. They tend to be a little expensive relative to others. But more importantly is, what if you're 45 or 50 years old and you've got enough money saved up at least to retire? You may not be able to get at it yet, depending on the tax rules and all the rest. But the bottom line is, why continue to take risk when you have enough money? And that's one of the biggest dumb things, if you will, about these life cycle strategies. The dynamic allocation strategies proposed in this paper exhibit almost stochastic dominance, which means they win every time, over strategies that switch assets unidirectionally without consideration for portfolio performance. So if I was you, just to save you a little money down the future, move your money into something else. Get together with a financial advisor, JBA Wealth, or whomever, but they can help you out. Watch for the changing economic environment. I get up every morning. I look at the numbers every day to try to figure out if we're moving more towards a growth or more towards a a worrisome economy, and I dynamically, strategically allocate money. Not all the time, but I will make adjustments along the way based on what I'm seeing happening in the economy. And then last, how do you track your portfolio? My favorite probably is FinViz. I have all my portfolios set up on FinViz. You can do it on Yahoo Finance. You can do it in Excel. There's a lot of Python, that kind of stuff. You do a lot of different things, but I can track my portfolios both in stock charts and in FinViz and programs like that, and have a real good picture of what's happening every single day. As a matter of fact, I pay for the more recent stuff. It's still only like 30 or 40 bucks a month, but stuff that is literally seconds old, so I can see as the day progresses what's winning and losing for me. All right, books out there. Buy Paul's book. It's on our books part of our Dr. Frank's Finance World. It's a pretty good book. He has a lot of interesting ideas. Watch those videos. Conquering Uncertainty by Theodore Modis is another favorite of mine because it talks about distributional assumptions and how the natural distribution of things tend to fit in the market. We did research look at it. Strategy tip: use the process information that makes sense to you. You have to be happy with what you do every day and make sure you get comfortable with that process. You can learn a lot and probably perform better from reading. I read all the time, and I think that helps me a lot. So don't forget to send me emails with comments and suggestions, and ask Dr. Frank. If you send the questions, I will answer them. Have a great day. See you guys later. Bye-bye.